Good morning, everyone,
Morning.
and welcome to our DAT IQ weekly market update. This is our update for January 11th, 2022. I'm Ken Adamo, Chief of Analytics here at DAT, joined as always by Ned Damon, Principal Data Scientist, and Dean Croak, Principal Industry Analyst. Good morning.
Good morning.
Good morning. Hey.
Did you guys catch a football game last night?
I did not.
No,
I
sorry.
was busy doing the dishes and cutting my hand open. So, you know.
Yeah, I mean, unless you're like an SEC or Georgia fan, I'm pretty sure like a rerun of Diners, Drive-Ins, and Dives had better ratings than that game. It was a little sad.
Right.
But hey,
Apparently
congratulations to Georgia.
Yeah.
42 years or something like that, first title. Beat the GOAT. All right, we're not here to talk football because I don't think you guys would sign up to watch that. We are here to talk about freight markets, what we're seeing, interesting trends, but most importantly, to answer your questions. So go ahead, drop them in the chat or the comment section, and we'll be sure to get to those at the end of the show. Please try to get them in early. We're trying our New Year's resolution to trim our waistlines and maybe trim the run length of the show a little teeny bit. So with that, I'm going to jump into our key trends. So spot rates, as you would seasonally expect, have come down, but I mean, they're still up like 54 cents. Yeah, 54 cents year over year. Kind of crazy to think about. Load post volumes 80% higher. I will say there is some interesting weekly phenomena happening there, right, where we had clean week. And what I mean by that is the holidays fell on a weekend. So that means you had Christmas and New Year's both on a Saturday, which meant you had full weeks separating and following. So just keep that in mind. So equipment posts down. Again, I think that's more indicative of trucks searching rather than posting. Winter weather definitely impacting freight markets. Luckily, Northeast Ohio has avoided the snow, but not the cold. And then I think this is an interesting one that Dean put in here. A lot of friends of mine have Teslas, older Teslas, that have been in the shop this past couple of weeks and will be for the upcoming weeks getting their 3G chips updated to 4G as one of the major 3G cellular networks is going to sunset in a little over a month. So with that, I'll turn it over to Dean to walk us through our market update.
Yeah, thanks, Ken. You touched on weather at the start of the show there. It certainly impacted freight markets. I'm looking forward to the 2021 annual report from NOAA that comes out on Thursday. It ranked in the preliminary press release, it ranked 2021 as the third costliest extreme weather year on record at about 145 billion and the fourth warmest. So more on the impact on freight later. Last week had a bit of impact regionally. But in the spot market, volumes were much higher, both year over year, as Ken mentioned. First full shipping week of the year, much higher, running at about the same level of load posts that we see the week after the polar vortex last year. Equipment posts on the carrier side are running about the same level as when the carriers were shut down during the polar vortex, just for some sense of comparison. So the load-to-truck ratio last week almost quadrupled as a result, up to 11.97. In the refrigerated category, very similar trend. Reefer load post volumes were up very high last week, about 23% higher than the polar vortex extreme event. As a result, the load-to-truck ratio last week more than tripled to 32.58. I think next week we'll see those load-to-truck ratios come back down to some more normal levels as we get into the third week of the year. Having a look at the load board activity in flatbed, load post volumes are currently running about 60% higher than the same time last year. Carrier equipment posts are slightly lower than week 2 last year, so the load-to-truck ratio moved down slightly to 86.95. Having a look around the markets on our market condition index, as we mentioned, the first full shipping week coincided with some extreme weather events last year. Heavy snow and ice in Virginia, Washington State, New England. Despite New England storm, I think it was Winter Storm Barrett being categorized as being a bit of a large event in the forecast, it turned out to be a bit of a non-event, just 12 inches of light fluffy snow. But the big event really was in Virginia, where the I-95 was shut down for 24 hours over a 50-mile stretch. But the other big event, of course, was in the Pacific Northwest, where the Snoqualmie Pass was shut down for 3 days on I-90, opened yesterday, but a lot of impact regionally. Most evident in Virginia last week. Spot rates surged by 30 cents a mile to an average outbound rate of $3.31 after being relatively flat since mid-December. So lots of impact of the road closure on I-95 last week there. Washington State, a lot of activity in the markets trying to get into Washington State. The I-90 closure is a major thoroughfare from Salt Lake City, Twin Falls, up into the Seattle market. So we saw lots of rate movement in Twin Falls, Spokane, Salt Lake City. Rates in those three markets jumped 10 cents a mile last week to $2.77. Twin Falls was the market that had the tightest outbound capacity. Rates there increased 36 cents a mile to an average of $3.14. On some of the high volume lanes out of Twin Falls for dry vans, loads to Stockton, up substantially, up to $4.60 a mile last week. That's excluding fuel. And on the I-5, there was a small closure last week, so capacity did tighten. Seattle to Stockton up to $2.58 a mile. That's not only the highest rate in the last 12 months, but it's $1 a mile higher than the same time last year. That's Seattle Stockton by the I-5. Having a look at the refrigerated market, same story in Twin Falls last week for reefer capacity, very tight. Reefer rates jumped 18 cents a mile out of Twin Falls to $3.85. For loads from Twin Falls to Stockton, another busy lane for reefer carriers, up 80 cents a mile over the December average to $4.44. That's $4.44, while loads east to Chicago also hit a 12-month high of $3.68. The disruption to freight networks on the West Coast because of extreme weather patterns has impacted rates on a multitude of lanes, including Chicago out of Los Angeles. Spot rates are up 8 cents a mile last week to a 12-month high of $3.44. That's about $1 per mile higher than the same week last year. And in the Southeast, reefer capacity was very tight last week in the Tifton market in southern Georgia. Rates are up 40 cents a mile to an average of $3.43. Loads to nearby Atlanta from Tifton short-haul lane up to $5.80, while export loads out of Tifton to Savannah, only 180 miles away, hit a new 12-month high of $7.36 a mile, which is more than double the spot rate just 12 months earlier. So very tight capacity in southern Georgia last week as a result. In the flatbed market, capacity was very tight in Laredo on the southern border. Rates jumped 20 cents a mile to $2.57. There was a 34% increase week over week in load post volumes. Loads to the state capital in Austin hit a new 12-month high out of Laredo at $3.50, while loads east to Houston ended up 15 cents a mile to $2.61 after decreasing for the 5 months prior. Flatbed capacity was very tight in the Lubbock oilfield market last week. Rates jumped 30 cents a mile to $2.69. In Los Angeles, flatbed capacity was also very tight. Rates are up 7 cents a mile to $3.25. And not surprisingly, flatbed capacity was almost non-existent in Virginia as cold weather closed down the I-95 during last week's deep freeze. Average outbound flatbed spot rate peaked at $5.40 a mile last week, ending Saturday. Wrapping up with our year-over-year view at spot rates, national dry van capacity eased last week despite an increase in loads moved in our network. Loads moved in the van network are up about 19%. Spot rates decreased 4 cents a mile to an average of $2.74. That's 50 cents a mile higher than the same week last year in the dry van sector. Having a look at refrigerated year-over-year spot rates, 7 cents a mile decrease last week erased all of the gains of the prior week, with the national average sitting just over $3.15. And that's about 70 cents a mile higher than the same period last year. And wrapping up with our year-over-year look at flatbed rates, after remaining flat for the prior 2 weeks, last week's flatbed spot rate decreased 3 cents a mile to a national average of $2.64. For context, that's 42 cents a mile higher than the same period last year, and an amazing 61 cents a mile higher than the same week in 2018 when the flatbed spot rate rally was just getting started. So that's it for this week's market update. If you'd like to find out more about what's going on in the freight market, go to dat.com/market update and download our weekly report. So that's it for my report. Over to you, Ned, for the short-term forecast.
Certainly. Hello, everybody. We are going to be beginning by looking at the dry van forecast. In blue, you can see the market rate observed by DAT, and then off to the right, you can see a different set of forecasts. In red, the short-term forecast is expecting that this crest is just temporary and rates will continue very strongly up into the right. Ratecast is expecting seasonal pressures to more or less assert themselves as they've started to, with rates dropping by about 10 to 15 cents over the course of the next month. In the middle, in gold and silver, we have our two blended forecasts, which are mixtures of the two forecasts in different ways and in different amounts. The gold, they're kind of hovering in the upwards about 5 cents with a kind of muddled trajectory. Honestly, I think that Ratecast has a much better handle of this kind of a long-term seasonal pattern than the short-term model does, and I would expect that Ratecast would continue to be the better performer of the two. Next, moving on to reefer, we can see once again in blue the market rates observed by DAT. In red, the short-term is its expectation somewhat tempered, but it still is expecting very strong upward motion, mostly just a carryover from the very strong, sharp shock upwards for the holidays, heading up about 10 cents. In green, the Ratecast model is expecting a very steep decline over the next months, heading back down to where we were at the start of December. over the next 35-ish days. And then the two blended models in gold and silver are leaning more towards the ratecast forecast of downwards, although they are projecting a little bit less sharp of a decline, and the way that they're declining varies between the two of them. Finally, moving into flatbed, once again, we have the market rates observed by DAT in blue, and here we have more model convergence. The short-term model, again, still expects rates to be continuing upwards by about 10 cents. Ratecast is expecting seasonal pressures to assert themselves, things to drop by about 5 cents, and then stay more or less flat over the next 3 to 4 weeks. The blended forecasts in gold and silver are expecting rates to stay more or less flat, with might be a little bit of an upward or a downward pressure to them. And that is it for our market forecasts. And we're on to the IQ question of the week, which is a spicy one. How much will the vaccine mandate impact capacity, if at all?
It's a great question. Let me get it started. So thanks to our friends at Scopolitas Consulting, they were able to share with us the results of the ATA survey in their submission to the Supreme Court that's currently hearing the vaccine mandate. So as of going to air this morning, I haven't heard any news as to what the outcome was, but the survey findings were rather fascinating in terms of the amount of drivers that had been vaccinated across the freight network. In the survey, the average driver vaccination rate across responding carriers in the survey was 50% of drivers were vaccinated. Now that's as of September last year, so that may be a little bit higher since then. Of those that weren't vaccinated, 62% also stated they would not get vaccinated under any circumstances, with a similar number saying there were no incentives the company could provide to change their mind, potentially impacting capacity, of course, or on the supply side. When asked what they would do if a vaccine mandate were to be implemented at their employer, 25% said they would leave the trucking industry, 49% said they would move to a smaller carrier, not subject to the 100-employee limit. So that's where we stand in terms of the survey results. It's a great question. I can't help but think of surveys I was doing before the ELD mandate came in. I started doing surveys in 2016 and 17. Found a similar trend. Lots of drivers were thinking about leaving the industry anyway. ELDs just were a catalyst. I wonder if that's the same thing here in smaller fleets. Drivers thinking about retiring and leaving the industry. Lots of things happen, could just be a coincidence. But there's certainly an undercurrent out there of anxiousness from the drivers that I talk to about what this could mean. The general theme is that moving to a smaller carrier would be a more logical move for a lot of them if they were so hard and fast on not getting vaccinated. So that's where we are at the moment. I'll let you guys weigh in.
Well, if they're an older carrier and they're choosing not to get vaccinated, they could be leaving more than just the industry.
Good point.
So I think just to kind of like keep ourselves in a box here, I mean, this isn't a political show, but I think it's important to talk about this issue. I mean, ELD were a political issue, right? That was a government regulation that went in that materially impacted the capacity pool, and it was talked about here, there, and everywhere else, and we saw the impacts of it in our industry. We still continue to see the impacts of that in our industry. So I wouldn't view this any different, right? I mean, if this goes into place, and let me kind of even take a further step back. It doesn't have to be these broad, sweeping national mandates, right? When California passed some of its independent contractor regulatory changes, that had government flow downs, and it's hard to do that just for one state, and even going back to CARB. So even like these smaller changes have impacts that range in, obviously, if you're running a bunch of California freight, but even if you go to California at all, you could be impacted by things like that. So just to kind of like level set the playing field, we're not talking about this as a political issue, more of just like, okay, if 50% of drivers, what was the exact number? 55 were vaccinated, Dean?
Well, 50% are vaccinated as of September.
Okay. So let's assume, for the sake of argument, it goes up 10 points. Since then, we're at 60. If you wipe out 40% of drivers, that's problematic. If you wipe out 5%, so best guess, ELDs took out 10 to 12%. I don't know if that still holds, but when I was in the industry, 10 to 12% of latent capacity evaporated. Now, I think we've clawed a lot of that back through efficiency and learning to live with ELDs, but that was like 10 to 12%. And if you were here and you lived through 17 and 18, you know what I mean by saying it was just insane. What would losing even 5 to 10% right now of the capacity pool mean, Dean or Ned?
It would be really rough.
Yeah. Especially the next 6 months, right, before the market sort of starts to stabilize. I think that would have a pretty significant effect. I mean, there are signs capacity is easing, but in some regional markets, it's still incredibly tight when you look at some of the upward rate movement. And I can't help but think this is also a bit like drivers saying, if they force me to drive an automatic, I'm going to leave the industry. And those same drivers, when you talk to them, will never go back to twin sticks or single stick shift trucks. So I don't know. I don't know if that's in the same category, but I think that this is a pretty serious subject for drivers, and I'm not sure some of them realise the consequences. A good friend of mine here in New England got a breakthrough case and has asthma and is still on an oxygen bottle, and it's a pretty serious thing for drivers that do get exposed to this. So I think the saving grace part of this is that drivers social distance for a living. Being on their own and not being exposed to other people is it's just a rite of passage. Sometimes a lot of drivers drive trucks because that's their preferred lifestyle, not being around other people. So in some ways, hasn't been a big impact on them at all, unless of course they've got to go in for training. They work for a large company. They've got to go in for training classes. They've got to be around other people. They've got to go into dispatch at a shipper to get their paperwork. There's all sorts of areas where they can come in contact people. So. It only affects them, of course, if they don't come in contact with other people and are in their own cab and isolated most of the time. Pretty hard to do in a truck stop, though. So I think that's going to be problematic if they're not.
Yeah. So Dean, I have and Ken, one of the majority response to the people who said that they weren't interested in getting vaccinated was that they would move to a smaller carrier. And I guess my question is, that's not necessarily losing capacity; it's just shifting capacity to different business units. Mm-hmm. So I guess my core question is, do we expect like efficiency losses? Because those smaller ones, they're much more exposed to like changes in the market.
I think it'll be the same as what we've been saying on this show for the best part of a year, and that is that the disruption in the labour market will mean that long-haul trucking is not as attractive to a lot of people. Current generational trends are to be having jobs much closer to home. It's very hard to get home if you're a long-distance truck driver. So I think on this show we said probably 9 months ago that truckload capacity will remain tight in the long-haul area, even though that there will be a shift in labour to shorter haul regional as freighters move closer to populations. So I think that's where the capacity will even tighten further in the larger fleet sector. I think the smaller fleets, while their spot rates are high and they're agile as they are and the freight volumes are there, they'll continue to do pretty well.
What you said about the shift to shorter haul is kind of interesting, because I remember I was doing, and this is probably just a factor of the dynamics, but I was looking at the average length of haul coming out of the ports, and over the last 2 years, the average length of haul coming out of the ports has had this linear increase upwards. But I think that's more of a function of warehouse capacity than it is
length of haul has, though, in general.
Yeah,
length of haul has increased.
It's also the lack of warehouse space at major ports, right? So sometimes the translating cost becomes cost prohibitive. Some commodities that come in from overseas, in particular the cardboard boxes, will not stand being unloaded because they are literally squeezed into a 40-foot container. So they have to be shipped on a dray carrier, even as far as Chicago out of Savannah. Not unusual to see a lot of 40-foot containers moving much further inland than what you'd expect because of lack of warehouse space and the mix of freight, especially in that retail space that we've seen such growth rates in the last year.
Yeah, I think at the end of the day, just to put a button on this, or put a bow, I guess you'd say, on this, to get back in the Christmas spirit for a second. At a certain point, I think the last domino to fall will be requiring vaccination for domestic air travel, at which point I think all of this becomes relatively societally moot, right? I don't think it'll be a regulatory thing anymore. I think private business will determine that that's going to be a requirement because they're sick of putting up with spikes every 3 to 6 months. So again, we anxiously await the Supreme Court. Given the way things lean, I think it's not a slam dunk that the mandate is upheld.
Ken, Maersk put out a release this morning talking about sickness disrupting a lot of the ports around the world, and that's impacting their schedules and capacity. Wall Street Journal had a report this morning about how absenteeism because of sicknesses due to Omicron is affecting their ability to staff warehouses. So this current wave that we're in, we may be seeing some of an impact on the demand side, maybe even more delays for carriers spending time unloading docks that are already understaffed. Seems to be a logical outcome of the current outbreak.
Yeah, FedEx this morning, there was an article with the pilots, the delayed service because pilots came down with a nasty kind of peak of it. I mean, ultimately, where I was going with that point is, again, I'm not an epidemiologist, but just kind of reading as much as I can consume. At the end of the day, to live with the pandemic, people have to be vaccinated. So I do think we'll get to a point. Most major sporting organizations, a lot of schools are saying you can work, you can go to school COVID positive as long as you're vaccinated and masked, as long as you're below a certain viral load. I think things will start to get to a point where we're just going to ease back on testing and say, look, if you're vaccinated and you got sniffles, stay home or wear a mask. But otherwise, we've got to get back to work. We've got to get back to living. And at a certain point when, what's the tipping point? It's individual for everyone. I drove here today on somewhat slippery roads. I'm not an awesome statistician, but at the back of my brain, I thought this has to be a much riskier activity than popping in Starbucks with a mask on.
Right.
That's a triple vaccinated young adult. So we'll see. All right. So listener questions before we really kind of step in it, because I feel like we've done a good job thus far, remaining fairly apolitical. Although I did want to ask you, Dean, while we're on the vaccination topic, I wanted to open the show with this. So your wife's traveled to Australia. You've traveled to Australia during the pandemic. Right. You've underwent massive personal inconvenience and cost. How do you feel about if you were a star tennis player, you could have just scooted right in the country?
I'm so angry about this. It's beyond belief.
So we haven't talked about this, just so everyone knows. I'm putting him on the spot. I've been sitting on this.
Oh, I've been simmering on this one for a week. I've been texting back and forth with my sisters saying, how stupid is the Australian government to even let this get this far? But, for context, my wife spent 2 weeks in a hotel that cost her $3,000 before she could enter Australia. She's an Australian citizen. When I traveled to Canada, I traveled to Australia recently, I had to have multiple COVID PCR tests, both in and out of the country. And then this guy just swans in and he's about to hit the tennis courts. It's frustrating.
15 love, Dean.
Yeah, exactly.
All right. Let's get some listener questions here.
Paul Smith asks, I have freight from Massachusetts to New York and Massachusetts to New Jersey, but right now I'm not getting any carriers. In the month of December, I have lots of carriers, but as of now, I don't have a single carrier who wants to take that freight. Can you provide a solution? Have you tried the DAT Load Board?
Have you tried to get your CDL and buy a truck?
Yeah, mine's buried in ice. Otherwise, I'd dig it out and help you.
So Dean Croak will personally guarantee your freight.
It's a great question from Paul, because there's been so much disruption to the freight work in New England because of the storms last week. It has a ripple effect that takes its time to work its way out of the market, because a lot of trucks were held up for 12 to 36 hours last week, and that throws them off. That throws them out of cycle, out of sequence. So I think a lot of those trucks that would have been in here on Monday, for example, yesterday, they may still be coming into the market. So I think that may ease over time. It's a net inbound market, Paul. So you still should see capacity over time start to return to the market once the weather improves, or the weather continues to improve this week.
But yeah, also my suggestion of the DAT Load Board, if you haven't tried, the DAT Load Board is one of the most comprehensive freight load boards, the most comprehensive freight load board.
Yeah, I was going to say one of.
Yeah, one.
Hello. I saw a stat yesterday, and again, I'll say it here because it's not in writing, but I'm pretty sure of it. It was in one of our marketing decks that we're going to be launching in this upcoming year. 85% of all new carriers that entered the market last year signed up for our load board.
Right.
I mean, that is not just unbelievable in like the flippant sense. That is literally quite unbelievable. Like, as someone who works with data, that is tough. That is unbelievable.
Yeah. A good friend of mine, Ken, entered the market in June last year, bought a used truck for $50,000, bought a refrigeration van for about $70,000. I talked to him over the weekend. He runs mostly between Chicago and New England and as far south as Atlanta. Current average rate using the DAT Load Board is $4 a mile, week in, week out. And it's in the refrigerated capacity, just for context. Mm-hmm. Yeah. Loves it, loves the product, loves the transparency that the load boards provide.
Yay.
For sure.
On the subject of buying used trucks, Michael McNair asks, has this forum ever discussed the fact that used trucks with 300,000 or more miles are selling for $180,000 or more, and used dry vans are selling for $70,000? I feel like we have discussed this.
What does that mean? I don't understand.
Yeah.
What does he mean? A used truck is 180 and a dry, like, does he mean the trailer is selling for 70 grand?
Trailer 70 grand, and the used truck, it's 300,000 miles. So it's probably still got warranty. It's probably still got a couple of 100,000 miles of warranty on the engine and drivetrain, I think, depending on the make and model. So it's still got some value, but 180 grand is a lot of money. That's normally what you'd expect to pay for a really heavy spec, Peterbilt or Kenworth heavy haul truck. That's ridiculous kind of money for used trucks. So we talked about it on the show a little while ago that used truck prices have doubled in the last year when you look at the average 5-year-old truck. So
you can go back and find one of the old shows, and maybe we can leave a note in the chat once we find it. There was an episode we did with it Todd? One of those episodes where you showed the gavel prices from JD Power for used trucks 1, 2, 3, 4, 5 years old or something like that. And I think those are really good statistics to point out. I mean, you can't get new ones.
Yeah.
I mean, the Kenworth dealer I drive by all the time, has like box trucks out front. I mean, that's all they really have. It's like old box trucks with like the faded Ryder logo on the side. It's like, that's it.
Michael could also search on dat.com/market update and just type in used trucks, and you'll find my recent market update on that just before Christmas.
But it's rough. I mean, it's one of the things that's constraining capacity is that, we've talked about this, but like there are two parts to adding capacity, and one is adding trucks and the other is adding carriers. And normally what happens when rates are this high is that you get like a real flood of capacity that comes in, and that drives down rates. And I think that's one of the reasons why rates have been so high for so long, is that we haven't been able, the market hasn't been able to correct.
And it's a pretty big exposure if you're overcapitalized, right? Yeah, I was just thinking about it being overcapitalized when rates start to move down over the course of the year. That's a pretty heavy lease cost there if you're financing trucks at that level, trucks and trailers.
Yeah.
Anyway. All right, so I'm going to appease our BFFs in marketing, and we have a chance to break the 30-minute barrier here, so I'm going to wrap us up. Dean, real quick, plugs.
Yeah. Landline now, Wednesday evening, 7 p.m. Eastern on Road Dog Channel 146, and I'll be on live on Road Dog 146 at 8 a.m. Eastern with Jimmy Mack and Dave Nemo.
Anything for you, Ned?
I've got stuff. It's coming soon. I know I keep saying this, but it's exciting.
Good.
I can't talk about it yet.
The reveal. All right. The only thing I have to plug is new year, new head count. I think I just tried to do the math in my head. My department has over 10 open positions. So again, I said this last week, and you'll continue to hear me talk a lot about it. Go to our website, go to LinkedIn, Indeed, built-in. We have Portland, we have Denver, we have remote, we have product management, we have data science, we have data analytics, we have sales engineering. You name it, we pretty much have an open position in the field at an industry-leading company doing really great things in this space. So I highly encourage you to check us out. Me, myself, I will always prioritize industry experience. I think that's crucial to have as we build and release new products. So again, if you're listening to the show, odds are you have industry experience. If you're in any of those fields, give us a look. So with that, we're going to sign off for this week. We might have a guest next week. We might not. We'll see. End on the cliffhanger. Have a great week, everyone. Bye.
Bye.